I'm Fabrizio Zilibotti. I'm a professor at the Department of Economics at the University of Zurich, and I am the academic director, or scientific director, of the UBS International Center for Economic Society. So it is my greatest pleasure to chair this session entitled Towards a Stable Financial Pact. Let me start by introduce our distinguished panelists. I will introduce them in the order, the alphabetical order in which I will present. So in the middle, we have Thomas Philippon. Thomas is a professor of finance at the Stern School of Business of New York University. And in 2012 and 2013, he has been senior economic advisor to the French finance minister. Let me emphasize and congratulate Thomas for having recently won the prestigious Bernard Prize, awarded annually to recognize the work of young European economists under the age of 40 and to encourage research on macroeconomics and financial issues. His research interests include macroeconomics, corporate finance, business cycles, and corporate governance, and some of his recent research focuses on the leverage and the great recessions of the Eurozone, which will be topic of today's discussion. Second, we have Richard Portes. Richard is a professor of economics at London Business School. He is the founder and president of the Center for Economic Policy Research, CEPR. This is the most important network of economic research in Europe, a major public good that Richard built up, and they changed the face of economic research in Europe, and for which we are extremely grateful to him. He is also the Tommaso Padoa-Schioppa Professor at the European University Institute and co-chairman of the Board of Economic Policy. His research interests include, among many other things, international macro, international finance, credit default swap markets, the global and European financial crisis, and financial regulation. Finally, Axel Weber is the chairman of UBS since May 2012. From 2004 to 2011, he was president of the German Bundesbank, during which time he also served as a member of the governing council of the European Central Bank, as a member of the board of directors of the Bank for International Settlements, as the German governor of the International Monetary Fund, and as a member of the G7 and G20 ministers and governors. And from 2012 to 2011, Axel was a member of the steering committee of the Financial Stability Board. So let me very briefly introducing the discussion by highlighting a couple of salient themes. Lord Adair Turner made an excellent speech earlier on and introduced already some of those. I think one of the issues that certainly will be discussed is the fact that one of the pillars of the stable financial pact within the monetary union is a system of incentive and rules that ensures that the governments of the member countries run responsible fiscal policies. So the possibility of running expansionary fiscal policies during recession, which is something in general we would like to do, requires that the opposite, namely conservative fiscal policies, be run during booms. Unfortunately, it appears as if this principle has not informed the policy of many national governments in the Eurozone, which have run up their debt in good times, exploiting the credibility provided by the euro anchor and the low interest rate. So this raises now two questions. In the short run, should countries be forced into fiscal adjustment right away when their economies are still weak, or should one wait for better times to avoid that the fiscal adjustment actually chokes off and delay recovery? In a more medium long-term perspective, the question is what type of institutional arrangements should be adopted to avoid the reiteration of the crisis. The second, as again it was introduced in the previous speech, perhaps focusing on public debt alone is too restricted and even misleading. Many economists advocate the view that we should, the perspective of overall financial stability is better addressed by looking at the evolution of the ratio of total debt of GDP and to its single components: governments, households, banks, financial sectors, central banks, etc. So there has been this recent Geneva report from the CEPR that actually shows that the world as a whole is still leveraging up. If we look at the Eurozone, there was a remarkable boom in the total debt to GDP ratio between 2001 and 2009. Since then, this has leveled off, and household debt has stabilized in recent years, but it has not gone down, which is different from what has happened in the US and also to some extent in the UK, where instead household debt has decreased. On the other hand, in these countries, there has been a significant increase of the public debt to GDP ratio, which has been stronger than in the remaining area of that has been stronger in the Eurozone, sorry. So a question that will certainly be discussed is whether we can have a stable and robust financial system at the current high levels of leverage, and if not, what is the best strategy to deleverage at the lowest cost, given the current uncertainty about the economic situation. So to address this and other question, I would like to give the floor to the first speaker, Professor Thomas Philippon.
Good morning. Thank you all for coming. Speaking after Lord Turner is always a tough act to follow, so I'll do my best. I'm going to ask a somewhat related question to the question that Lord Turner was asking, but somewhat less ambitious. That is, I'm not going to try to explain the entire leverage dynamics for the world economy. I'm going to ask a more precise question, which is what would it take for the Eurozone to be as stable as the US economy? In other words, think of the Eurozone and the US as two large currency areas and ask the precise question, what exactly is needed for the Eurozone to become relatively as efficient as the US currency area in dealing with various kinds of shocks? All right, so if you want to answer that question, first you need to have some understanding of what went wrong in Europe. And I think it's fair to say that we are not there yet. There's still much disagreement about what happened during the Eurozone crisis. So Hans-Werner Sinn, who actually is going to speak later this afternoon, tends to emphasize the fiscal issues. So he views the crisis as largely driven by a breakdown of fiscal discipline. Then Paul Krugman, on the other hand, views the crisis as essentially a result of a private credit bubble. Paul de Groot then instead views Eurozone countries as essentially emerging markets, in the sense that they borrow in a currency that they don't control. So the question then is, who is right? So you might think that we would have an answer by now. We don't. And the main reason, I think, for this disagreement is it's very complicated. So what do we mean by complicated? So this is meant to scare you. If you actually start thinking about what these three perspectives means, that is, fiscal discipline, credit bubble, and the possibility of a sudden stop, if you start thinking about what they mean in terms of who does what, which agent in the economy does what, you end up with a tangled mess like that. Because all of these forces obviously are interacting. So then the question is, how do we make progress? And I think that's the job of academic economists, to make progress on this issue. And to do that, you need to actually write down what we call a model, which is a way to think about these three issues together. So this is based on joint work with Philippe Martin and other co-authors. And so essentially our view is that we got to have these three interrelated forces, that is fiscal imbalances, private debt imbalances, and the risk of a sudden stop. And the first thing you need to do is recognize that these three forces interact. So for instance, obviously, if you have a fiscal expansion, that's going to raise disposable income, it's going to raise aggregate demand, it's going to raise consumption. It might actually alleviate the need for the private sector itself to borrow. It's going to create more debt. It's going to create more credit risk going forward. So that's going to increase the possibility of a sudden stop. On the other hand, once the sudden stop starts and you're forced to delever quickly, you're going to have a recession in the economy, which is going to feed into perhaps higher debt levels. So you can't possibly think of each issue in isolation. You have to model all of them together. So the model is this. So don't worry, I won't go through all the equations. But the model is meant to capture all of these interactions. So then what needs to be done? Well, first of all, we need to figure out exactly what we want to measure. So we looked through the data that we need to quantify all of these issues. So this is just one example. So when we think about leverage, so this is the dynamics of household debt and sovereign debt for each Eurozone country. So I say each because, so actually we have 11 countries, because these are the 11 countries for which there is a reasonable size and the data is reliable. So you see the dynamics of this debt, both private and public. You can see the private leveraging in green during the boom, and like in a country like Ireland, clearly this very large increase in private debt, then the private deleveraging at the same time as the public leveraging goes up. So it's very similar to the kind of dynamics that Lord Turner emphasized earlier. So we're going to do that for every single variable of interest. That means GDP, employment, inflation, net export, government bond spreads, all debt levels, all spending. Put them together. And the key idea, again, of the model is that it takes into account the things we think are important. That is leverage, fiscal multipliers, bond pricing, credit risk, and all of that. Once you've done that, you check that the model makes sense, and then the key thing, the really important thing, is you run counterfactual. That, I think, is the crux of what we need to do as economists. We need to run counterfactual. That is, we need to ask the question, what would have happened if we had done something else? So think about what it means. So for instance, in terms of fiscal discipline, you want to be able to answer the question, what would have happened to Greece, Ireland, Portugal, name your country, if they had run a more conservative fiscal policy in the boom? That's the question we want to answer. That's why it's so hard. Because if they run a different fiscal policy in the boom, then the entire history is different. They don't have the same employment. They don't have the same private debt. They don't have the same bond spread. Everything is different. So you need to rewrite history, really, literally. You need to re-simulate the entire past of all of these countries, assuming, say, a different fiscal policy. So that's for fiscal policy. You do the same thing for, say, macroprudential policies that would target private leverage, and then for sudden stops. So that's what we do. And then you have the crucial issue of how can you possibly identify these effects? So how do you know what, take, I think, the important one, what would have happened to Eurozone countries if there hadn't been a sudden stop? That's one of the counterfactual we want to run. So how can you hope to disentangle that? How can you say, well, what would the Eurozone look like without a sudden stop? Okay, so that's where I think the critical idea was, let's do the US, let's use the US as so formally we call that a control group. In other words, think of, what I'm going to say is that the dynamics of Ireland would have been without a sudden stop. Well, this would have been exactly the dynamics of one state in the US. Okay? So I'm going to say the US, as a monetary union, has different states, and they're all going to have the same kind of private imbalances that we observe in the Eurozone. The key difference is they don't suffer a sudden stop. And you see that, so this is the comparison of employment dynamics for Ireland and Arizona. We also, of course, looked at debt dynamics, private debt dynamics for Ireland and Arizona, and they're also very similar. So in both places, you see a very large employment boom, and this is all relative to the mean of the particular currency area. And in fact, the same boom, and in the background, you don't see it here, same boom is private leverage. When the deleveraging starts, the same drop in aggregate demand in the Ireland or in Arizona. Same drop in employment, and in fact, remarkably, up to 2009 or 10, that is before we enter the sudden stop issue and before the bond spreads blow up, very similar dynamics. So that tells me that private leverage dynamics, and by the way, in both cases driven by real estate bubbles, but private leverage dynamics and private real estate bubbles were very similar in both regions. In fact, I can show you more. So this is one example. We look at every state in the US, every country in the Eurozone, and we can show that the dynamics were extremely similar as far as private leverage is concerned. And that goes all the way to 2009. After that, of course, we add another layer in the Eurozone, which did not happen in the US, which is the sudden stop, which is when the bond markets start to think, oh, maybe that country will not stay in the Eurozone. Nobody thought Arizona would be kicked out of the US monetary area, right? But people started thinking maybe Greece would be kicked out. So that's the critical difference. So if you give me that is, if you allow me to interpret the Eurozone as the Eurozone without a sudden stop as looking like the US, then I can run counterfactual. So I'm going to show you what would have happened with different fiscal policies, macroprudential, and monetary policy. So this is the fiscal counterfactual. So what do we do here? In blue, you have the actual evolution of public debt in these countries. And of course, the big drop at the end for Greece is when we write down the debt. And in the dotted line is, think of it, the simple way to summarize it, imagine each of these countries being run with a mildly countercyclical conservative policy, which actually, for instance, describes pretty well what Germany does. Okay? So think of it as the counterfactual for Greece is this is Greece with a German fiscal policy. It would essentially have kept debt exactly constant. Okay? So a huge difference in the level of debt. For Ireland, you can see here something that's very important that we'll come back to later. If Ireland wanted to stabilize its economy using exclusively fiscal instruments, then by 2007, it had bought back the entire stock of public debt. That suggests that that would not have been enough to stabilize the economy. You need more. But of course, if you run a more conservative fiscal policy in the boom, you don't have the buildup of credit risk. Your spreads don't blow up, so the counterfactual spreads are much smaller, which means you can stabilize your employment. Instead of having this gigantic boom-bust cycle in employment in Greece, you have a very stable employment rate, which is close to its natural rate. So that's a fiscal counterfactual. You can do the same thing for macroprudential. So here, let me just emphasize Ireland, if you want. Remember, for Ireland, if they wanted to stabilize employment using fiscal policy, the boom was so big that they literally ran out of public debt to buy back by 2008. Instead, if they had a policy to target LTV ratios, so loan-to-value ratios in the private sector, then that would have been successful. Finally, we can do a counterfactual with... so this one is actually assuming that Mario Draghi's speech, the famous 2012 speech he gave in London, where he said, I'm going to do whatever it takes, assume that speech happened in 2008. So essentially what it does is it prevents the explosions of spreads across regions. And you can see what it does to Spain. Of course, it doesn't prevent the big drop, the boom and part of the burst of Spanish employment. That's true, but that burst happened in Florida and Arizona as well. That was not avoidable. That got nothing to do with having a bad currency union. They're saying there was a crazy private bubble. But what it does is it prevents employment from dropping below 1 after that. Okay? That's the key difference. So if you had this kind of policy, you would have prevented the worst part, the second half of the recession in Spain. So what's the lesson? Well, this is pretty obvious. So let me say that I started with a view that was not necessarily heavy on the fiscal side. I came out convinced that fiscal policies were actually very important in the boom and in the bust, so that fiscal discipline is a key ingredient for having a stable currency union in Europe. It is clear also that it's not enough. There are examples we can show quantitatively that you just run out of debt to buy back in the case of Ireland, so you do need macroprudential. And finally, there is a large cost of inner currency union of letting the funding costs diverge across region. So then, to conclude, what does it mean for us going forward? So I don't want to give you a definite answer. I just want to highlight a few issues so that we can have more informed discussions later on. So first point, fiscal discipline. As I showed, this is actually very important quantitatively. Now, the thing is, there are two ways to get fiscal discipline. One is to have a fiscal compact or to have very specific rules that prevent government from borrowing too much. That's one way to do it. Another way to do it is to actually make government debt explicitly defaultable and let the market discipline the debt. Which one is better is not obvious, but that's something we need to keep in mind. I have a view on that, I can tell you later. I think that in the long run, defaultable debt is the only sustainable way to do it, but in the short run, it's less obvious. Point number 2, the banking union. Well, the key thing about the banking union, really, is to ensure that the private sector cost of fund is equalized across region. And very importantly, independently of the health of the sovereign. That has to be a critical factor. So to the extent that the banking union is going to achieve that, and I'm reasonably optimistic it will, that's going to make, that's a huge step forward for the Eurozone, and it's going to make it a lot more similar to the US. So I think just by itself, this is actually a great step forward. We underestimate the importance of this impact going forward. The open questions, I would highlight 2. First, do we need to go beyond the banking union? That is, do we need what is now being discussed as a capital market union? That is, do we need to also proactively encourage the integration of equity markets and bond markets across the Eurozone because it's a currency area? I would say yes, and I can explain to you later why I think it's important. The second key question is, especially if you think that in the long run, you need some kind of explicit defaultable debt to keep fiscal discipline, then I think the flip side of it is you also need to create a safe asset at the level of the Eurozone, which you're going to be using for banking regulation, monetary policy. And in that vein, I've proposed earlier on Euro bills, which is to at least have some kind of common debt, which is at the short end of the term structure. Thank you very much.
Thank you, Don.
Good morning, and my thanks to Fabrizio and Ernst for having invited me. It's a pleasure to be here. I will find some overlap, or you will find some overlap in what I have to say, both with Darius Turner's remarks and with Thomas Philippon's. But we'll get there when we get there. Let's see whether I can get this machine to...
No, the other one.
Huh? But maybe it's this one. Yeah, are we working with this one, all right?
Yeah.
Let's see. Yeah. It's the other. It is the other one. It's just slow. There's a lag. Okay. So I'm going to talk about the threats to European financial stability. And I come at this with the perspective of an international macroeconomist working on international finance. And therefore, I put a lot of emphasis on capital flows. And I think the main source of the crisis, and Adair referred to this, was the capital flows that went from the major surplus countries, in particular Germany, but also France and the Netherlands and the UK, into the peripheral economies, if you like. It was monetary union that did unleash these capital flows by eliminating the currency barrier restriction, but financial integration that promoted them also, very conscious financial integration with legislative measures to do so. And then all this was accentuated by, again, a kind of international version of what Adair was referring to earlier, and that is the global financial cycle and the international credit channel that operated within, in particular, within the Eurozone. But I believe that monetary union is, in fact, robust when it has a credible lender of last resort, when it has institutions that limit systemic risk, and when it has sensible restrictions on fiscal policies, echoing what Thomas just said. There are still cross-border burden-sharing issues, in particular if systemically important financial institutions, SIFIs, get into trouble. But these are political issues. They're not for economists to sort out. And what we need are institutional mechanisms to do so. Let's see. I'm pressing again, but I'm getting this lag. Let's try. There we are. OK. So the capital flows stopped when the crisis came. And the problems since then, I believe, are due to inadequate monetary and fiscal policies, inadequate stimulus policies, the unwillingness to permit sovereign default, in particular the case of Greece, and the delay in creating and affirming the role of the European Central Bank as a lender of last resort. So it's not the usual suspects. We shouldn't be looking to round up the usual suspects. Fiscal profligacy was really only the problem leading up to the crisis in Greece. And indeed, under Thomas simulations, if you had a more restrictive fiscal policy in Ireland, its public debt would have disappeared, right? Well, that's politically infeasible as well as economically undesirable. So that's the first. The second, I believe, inappropriate suspect, not guilty, is the asymmetric shock story that we heard prior to monetary union, that the union couldn't possibly cope with asymmetric shocks because it didn't have the proper adjustment mechanisms. We've been learning things about this. For example, labor migration actually within the monetary union now is much greater than people were talking about, and it's actually almost on the same level as labor migration within the United States, but that's another story. And the third story is that the problem was the inadequate competitiveness of the crisis countries, their rise in unit labor costs relative to Germany and so forth. That, too, I think, is just not where the story is. And focusing on any of these going forward gives us the wrong policy mix. So what are the policies we have to look at? I will consider very briefly four. One is to maintain that lender of last resort role credibly for the European Central Bank. The second is, indeed, to build a healthy banking system and to shift, as Thomas was talking about with capital market union, to shift to some extent financial intermediation away from banks towards security markets. Not that we need to look exactly like the United States, but the balance now is too heavy towards banks. The third is deleveraging. Adair talked about it at some length. It's very difficult. But indeed, deleveraging, not just for governments, not just for banks, not just for households, all through the financial system, that is tough. And finally, macroprudential policies to avoid getting into the next crisis. Now, what about the credible lender of last resort? We've heard about the whatever it takes speech. This, of course, creates moral hazard. The lender of last resort creates moral hazard. There's no way around that. The question is how you limit it, how you contain it, how you deal with it, and there you need appropriate conditionality, and that's perfectly consistent with the origin of discussion of lender of last resort, namely Walter Bagehot's work in the 19th century. The third is that we have to be willing to permit restructuring of government debt if a debt burden is unsustainable. The bailout of Greece in 2010 was a grave, grave error. Now, could the European Central Bank let a large country default? That is to say, not intervene to stop it from defaulting. The effects on the banks, as currently looking at their current balance sheets, the effects on the banks in the home country would be pretty strong, not very nice, and there is, after all, a lot of this government debt held outside the potential countries in question. So it may be that some countries are too big to fail, and we haven't really grappled properly with that issue. More broadly, and this is supposed to be about this day is supposed to be about the institutional foundations for a healthy system. There are issues about whether the European Central Bank should be in the business of enforcing what conditions which have major political aspects to them. And an even broader issue about whether the European Central Bank has become, willy-nilly, an overly powerful institution. No problem, I think. That, I think, is something, too, that has to be dealt with now that it incorporates the single supervisory mechanism and as the leader of the European Systemic Risk Board, the macroprudential authority, is the president of the European Central Bank. So the healthy banking system. Well, there have been efforts, of course, in this direction, substantial ones. We have a new single supervisory mechanism for that is to say, across the euro area for the larger banks. And they have just completed their comprehensive assessment, which involved an asset quality review of those banks and stress tests on those banks. It's a start. It's a start. The associated single resolution mechanism that is supposed to deal with the case of a possible bank failure, that is a weak and right now effectively an empty shell. That is not a serious thing yet, at least. We shall see. But the stress tests, the asset quality review was, I believe, a pretty professional piece of work. The stress tests, I would probably argue with those who have said that they were insufficiently rigorous, insufficiently tough, that not enough banks were revealed as short of capital. But still, that too can be remedied as we go forward. What is an important omission is that they didn't even try to capture the interdependencies of one bank on another, and indeed, broadly, the system. We could come back to that if we like. It's a big, big issue. The follow-up will be, being tough in the follow-up will be essential. But one thing that is involved and has come out of the follow-up, there's a story in today's Financial Times that the single supervisory mechanism is preparing to force the banks to divest themselves of a substantial proportion of their domestic government bond holdings. That is to say, we've seen a concentration of these, a repatriation, if you like, of sovereign bond holdings in the post-crisis period, a kind of financial fragmentation, disintegration, and the consequence of that is this heavy burden of domestic government debt on bank balance sheets, and the single supervisory mechanism wants to reverse that. There is evidence of overbanking, again, the balance between the banking sector and the securities markets, but the proposals for capital markets union are right now completely up in the air, and we'll see whether they do come up with anything interesting. Deleveraging, that was the theme of Adair's talk. I won't go into it in detail. There is indeed not much progress, and he referred to that Geneva report. The debt burdens have not come down significantly, and I started off work on a number of these issues in the 1980s, looking at the sovereign debt crisis in Latin America and the consequent debt overhang. What is indisputable from historical evidence going way back and up to the present is that debt overhangs are inimical to growth. They act effectively as a tax on investment, and a tax on investment is a tax on growth. Without growth, conversely, without growth, those debts are not going to be sustainable. Mutualizing the debt across countries, if you look, of course, at the Eurozone as an aggregate, the debt burden is no greater than that of the United States, but it's not an aggregate. And yeah, so I've just got one more, I think just one more slide. The question is whether you can do something about that debt overhang. The bank leverage is coming down, but household debt, the debt-to-income ratios are not coming down. Finally, macro-pru, that is the policy attempt to deal with systemic risk. And here, there are big differences of the way people think about this. The role of monetary policy, the role of interest rates in trying to combat systemic risk, the buildup of systemic risk, as opposed to macroprudential policies. And I haven't got time to go into that, but it's a big debate. I am on the macro-pru side, but I understand very well the arguments on the other side. Do I have a moment for this final? That is a final slide. You said that I might, the audience might be interested in an external perspective on financial stability here. The first point, and the really important, essential point, is that Switzerland, too, cannot escape the global financial cycle and that international credit channel. And it's very important, has been very important for exchange rate policy. When risk on. Switch is to risk off in the terminology of the financial community. You might think of it as a spike in the VIX, representing that. Then there's a big flow into Swiss franc denominated assets and a pressure for appreciation. And of course, the Swiss National Bank has capped the exchange rate for some period now with intervention policies, rather than using capital controls, as Brazil has done, for example. And I think it is absolutely the right policy. And being a credible force for intervention in the currency markets has meant that it hasn't actually had to do, except for particular moments of stress, it hasn't actually had to do that much intervention. But of course, this has generated political opposition, just as some of the actions of the United States Federal Reserve to stabilize the economy have generated political opposition in the United States. We see that now in this referendum proposal. I have to say, the referendum proposal that is up there, I believe that you would hear 99% of economists, at least the economists I know, and there are a lot of them, would say this is a bizarre idea. Just bizarre to require the SNB to hold 20% of its assets in gold and never to sell it. The whole point of reserves is that they be liquid. Excuse me. You got to be able to use them. I think this would be very dangerous, and there's a very nice short position paper of the Swiss National Bank on this. But I'll stop there.
Thank you.
Right.
Good morning, ladies and gentlemen. It's a pleasure being here. UBS Center, always interesting discussions, particularly happy to participate, given that it's just a stone's throw from my office. There are different views on the Eurozone debt crisis. Thomas Philippon and Richard Portis just presented theirs. The problems include too much government debt, too much government spending, too much private debt, a housing bubble that bursts, suboptimal currency area, and insufficiently integrated banking markets and insufficient integration of banking supervision. So there's a host of problems in the euro area. And as usual, when things go wrong, there's not just one reason why things go wrong. It's a combination of unfortunate circumstance. And in my view, this also applies to the Eurozone problems. But I don't want to dwell on the past. I want to look at some of the suggested solutions. Where we probably would all agree is there's a need for more stable Europe, a more stable Eurozone. And we probably also agree that we have several instruments. In fact, I see three main ones: monetary policy, fiscal policy, and structural reforms. Where opinions start diverging is which of the combination of the instruments is needed, and the contested issues, in particular, if you go instrument by instrument, on monetary policy, how much more should the ECB deliver, and what are the benefits and the costs of additional monetary policy stimulus. Concerning fiscal policy, how much leeway does fiscal policy have, and should it be used? And third, on structural reforms, most of us would agree that they are needed, except that incumbent governments do have very little incentives for reforms as long as markets are held in check by very accommodative monetary policy. So you see these policies interact, and they reinforce or they actually work against each other. I cannot present a solution for the euro system woes here, not because I don't have enough time in just 10 minutes, but I don't have a solution. I don't have a solution because the Eurozone problems are manifold, they're complex, they're deep-rooted, and they're not easy solvable. And there is no single solution, in my view, that fits all the parties involved. And basically what I'm going to talk a bit about is debtor and creditor countries have different incentives and therefore need different solutions. Ignoring those typically leads to a one-solution-fits-all policy, and in my view, in Europe, that's actually ill-advised. Despite low record bond yields in most European countries, Italy enjoys funding costs that we haven't seen around since Genoa in 1640. Despite low funding costs, debt problems in Europe have not been solved. It's just masked by easy monetary policy, by zero or even negative policy rates, by balance sheet expansions, both private and public sector, and central banks, and in particular by the OMT promise. The OMT promise, again, and Richard portrayed it as nothing different than Bagehot's lender of last resort. I tend to disagree. It's not a lender of last resort, it's a buyer of last resort. And a buyer of last resort is nothing else than basically a bailout promise by the central bank. Historic evidence shows that when government debt approaches 100% of GDP, things can get out of hand. Government debt, in particular, if you look at ratios of GDP in 2014, according to the latest European Commission estimates, are as follows. Italy, 132%, Spain, 98%, France, 96%, and rising in all of the three countries. I've got a little chart here. Germany, 75%, Switzerland, 34%. Switzerland is not part of the EU, and I've not put it in there right now, and I've not put it into monetary union, just as a comparison for the home audience to see what debt numbers are. And basically, in both Germany and Switzerland, debt levels as percentage of GDP are falling. Germany just moved to a balanced budget. When talking government debt as an indicator of sustainability, we cannot make progress on debt sustainability in European countries. Actually, in my view, things are getting worse. Things are getting worse because government debt is rising in many countries as a ratio of GDP because deficits are still large and looming. Italian deficit is 3% of GDP, Spain 5.6, France 4.4. In Switzerland and Germany, on the other side, they have planned a balanced budget or are slightly in surplus. High deficits combined with low or even negative economic growth and with low or even negative inflation increases the debt relative to GDP. The Eurozone is therefore, relative to GDP, going further in debt and not the opposite direction. In addition, some European countries have large foreign debt. For another chart here. Italy, 32%, Spain, 98%, France, 17% of GDP. Germany has net foreign assets of 46% of GDP. Switzerland has net foreign assets of 144% of GDP. And if you look at levels globally, the biggest net foreign creditor nations are Japan, followed by China, and then followed by Germany and Switzerland. So small Switzerland is the fourth largest international net creditor country. The globally, again in levels, biggest net foreign debtor countries are the US, followed by the UK, and then the likes of Italy, France, and Spain. Monetary policy cannot pay back debt. Monetary policy can only do two things. First, during the crisis, it can avoid a general financial panic by providing ample liquidity. That's what Bagehot asked us to do as central bankers. And second, after the crisis, it can buy time in order to accommodate the necessary reforms. And our forms and reforms are needed, but in my view, the reforms are not one size fits all. Debtor and creditor nations need different sets of reforms, and I'll talk a bit about that later. What the ECB and other central banks have done is buying time. They averted a meltdown in the financial system and bought time for reforms to kick in. But it's very hard to imagine that we can ask them to deliver more. They won't, simply because they can't. In my view, in particular, the ECB can't deliver inflation at this point in time. Remember that inflation is one way to reduce debt. It's not the only one. You can grow out of it, a very unlikely perspective for the European development. You can actually have debt restructuring, debt forgiveness, debt defaults. That's another way. And in my view, the third one is really to have some financial repression, and zero interest rates, in my view, are very close to financial repression. So what the ECB can do, in particular, is they can try and mitigate measures and buy time. Remember that inflation is basically one way of doing that. That's what I just tried to say. But why is the ECB so frequently criticized at the moment for not delivering 2% of inflation? Why can't they deliver 2% inflation right now? Well, first, in my view, there are a number of reasons why this is hard to do. The main driver of inflation is the output gap. We know from academic research it is very difficult to measure the output gap in real time. However, forget all the formulas. What I'm pretty sure about, and I dare to make a prediction, is that the Eurozone output gap is probably quite large at this point in time, and therefore in itself has a deflationary and not an inflationary impact. Second, inflation has become more global in recent decades, meaning that inflation depends more and more on global factors such as commodity prices and global output gaps, and less on domestic factors such as domestic monetary policy and domestic output gaps. And on a global scale, inflationary pressures are absent. Most countries experience very low inflation rates currently. The global output gap is probably also negative as well, depressing global inflation further. Commodity prices have fallen by more than 29% since June. This trend continues, adding further pressure on global disinflation. 13 out of 34 OECD member countries currently exhibit negative year-on-year inflation rates. In my view, there is no way the ECB can generate significant inflation in the foreseeable future, whatever it buys, however much it buys, private or public sector debt. There is one reason why the ECB's debt buying may help on some front, and that would purely be, in my view, debt redistribution. That's a non-neutral monetary policy. It's not within the mandate, and you heard some economists refer to the OMT for that reason as an out-of-mandate transaction. In my view, that's a very harsh view, but it clearly is questionable whether at this point in time the ECB can deliver inflation. Inflating the euro at all costs will also not produce more consumer price inflation, in my view. It may severely have the side effects that I talked about, either debt redistribution or risking inflating asset bubbles in some areas of the monetary arrangements. The ECB cannot, and therefore in my view will not, solve the Eurozone's problems. In fact, easy monetary policy may even prolong or exacerbate the situation because it mitigates the pressure for structural reforms and it will delay them. The root of the Eurozone problems, in my view, are different. Eurozone structural reforms, in my view, are needed in order to free the economies of excessive burdens that are needed, in particular in the area of too much regulation, a quite strong anti-business environment, very strong and oversized governments, very strong debt dynamics, sclerotic labor markets, and all of this, we know, is not helpful on the long-run supply side of the economy. Governments, therefore, need to come into the game and support the ECB. However, the ECB has a number of areas where they are being pressured to do more. So, in my view, that would not be helpful. Let me come to the conclusion on what the other policies can do. Is there a role for fiscal policy? I think fiscal policy does have a role to play, and in my view, actually, there are certain circumstances under which fiscal policy, expansionary fiscal policy, can be helpful. However, we have to be aware that government expenditure as percent of GDP on average in the Eurozone is 49%. In Italy, it's 51%, in France, it's 58%. In Spain, for example, it's only 44%. Across-the-board expansionary fiscal policy, in particular in countries that have already oversized governments and very little room to maneuver because of past debt and deficit dynamics, therefore, in my view, is not a viable conclusion. It might increase the centrifugal forces of Europe rather than diminish them. Do we really need more government as a solution in Europe? Looking from Switzerland, my answer is clearly no. Do we need more taxes? In my view, it's clearly no as well. I'm not against expansionary fiscal policy as a government decides if it can afford to do so, but I would strongly advise expansionary fiscal policy to come at the shape of reductions of taxes and not in the shape of increasing government spending. And maybe a last word on the banking union, because it was talked about. Banking union was overdue. A banking union is a necessary precondition for a currency union to evolve. It is a sufficient condition, but in my view, in itself, it is not a solution to Eurozone's problems. Not having a banking union has added to the problems. Eliminating the banking union, unfortunately, will not solve Europeans' problems. Thank you very much for your attention.
Now ready to take some questions. Guido.
Yes. Question for Axel. So I think the logic of your thinking is very clear.
Microphone.
Hello?
Do we have a mic in the floor?
Yeah.
We do somewhere. Should do. Did before. Talk very loud, Guido.
Maybe we start.
We can
Go ahead.
repeat.
Yeah, you can come up perhaps, since you are here. Thanks, Guido.
I have a question. The logic of the argument is very clear. We don't want debt monetization because it would be debt redistribution. Probably, realistically, the way to get out of some of these high public debt is debt restructuring or default. You didn't say so as explicitly, but I think that is the logic of the argument. Now, I think it's important to take the reasoning one step further. I think in some of these countries, it may be better to leave the euro area than to default on their debt. And so the question to Axel is, do you really think that dismantling the euro area, or at least part of the euro area, to cope with the debt overhang is better than debt monetization? Thank you.
Do you want to answer straight away?
Let's do it.
Well, look, I find these are two completely different issues. The fact that my neighbor has the debt in the same currency as I do does not entail an obligation of myself to bail out the neighbor just because he has debt in the same currency. Wasn't the case under the D-mark, wasn't the case, in my view, under the euro. So the fact that we're talking a European Union and behave as if this was an arrangement where we guaranteed the debt of European countries per capita of European citizens is simply the assumption of a state of affairs that is not true. That would have been the case if we moved fiscal policy to the European level. And believe me, there would have been a lot of provisos put in place in order to make sure that the starting conditions for debt were very similar. So we would have converged for 20 years in debt before we actually mutualized the debt. Now we're in a financial crisis. Look, we all know the euro was started hastily. This was like a love marriage. You rush into it without a wedding contract. But clearly, when we rushed into this marriage, the assumption was everyone's debt is their own debt. That's the whole logic about the Maastricht country. So the Germans have been more rational when they started monetary union because at least they asked for a wedding contract and everyone signed it. But the fact that we now had 14 years, usually marriages in real life break out after 7, all the Hollywood movies, difficult 7th year, we're now 14 years into monetary union. And Germany and other countries that are surplus countries now in the union are reminding others that the source of the contract was not that the countries guaranteed everyone's debt. We only moved monetary policy to the European level and competition policy. And we're having a banking union now that is generated by contractual arrangements between member countries. There is no bailout that was part of the agreement. And I think what we have to do, like if we are in an over-debted situation in some countries, those countries that are in an over-debted situation need to show their commitment to go down medium to long term in order for this to be viable. If that doesn't happen, I think people will just understand that this is just going to lead to some adverse dynamics where you're going further and further into debt in countries that have already had high debt to GDP ratios. So instead of a convergence towards whatever the number was, 60 might have never been realistic, but instead of having a convergence of debt, medium to long term, we're seeing the opposite. And it's not the short-term cyclicality that Germany or others are concerned about. It's the long-term viability of a sustainable debt arrangement that people are calling into question. So forget about the fact that we're not talking cyclical policies here. What is required from a cyclical position might be totally different than what is required from a long-run sustainable position. But where the doubts in Europe have emerged is whether the long run is viable under current arrangements if we're not seriously attacking and tackling the long-term debt issue. And I think that's where the difference of views comes about. I don't want anybody to leave the union. I just want every country to do their homework and do what was originally promised when we started in this. Let's move to a situation where we move to sustainable debt levels that are low so we can reduce the amount of government expenditure, move to less taxes for the economy, have a vibrant private economy instead of having a government that is becoming larger and larger as we go along. I think that is just the wrong recipe. And if you talk about fiscal competition, look at Switzerland. The cantons have their own way to decide about the expenditure, the revenues, and the deficit. In Europe, the rule we had was a minimum intrusive rule to just say, we don't care about your expenditure, we don't care about your revenue, all we care about is the net below the line, and that shouldn't be more than 3% of GDP. That's not really a challenging rule. That's just, for me, a very basic rule that everyone needs to apply. If you want more than that, yes, you can start discussing expenditure, and that's the real one, and then you can start discussing revenue, but that's much more intrusive policy, and you shouldn't be asking for that. So where we are now, the arrangement as it is, it just has to be lived. I don't think we need a second contract. We have one. We just need to abide by it.
So,
yes, question for Thomas. You ended with a suggestion which other people have made, and I think it's a perfectly sensible suggestion, that in an ideal world we would have both Eurobonds, which were safe assets, and we would have market discipline at the level of what Charles Goodhart has called the sub-sovereign states of Europe. We would end up with a system which was exactly equivalent to US Treasury bonds and state and local debt, where there is assumption that the US Treasury bonds would never default because they are ultimately underpinned by the Federal Reserve, whereas state and local can certainly default and are subject to market discipline. What do you think, or does your model tell us anything about what the implications are then for where automatic fiscal stabilizers should operate? In the US, in that model, you fundamentally don't have strong automatic fiscal stabilizers at the state level, right? That is constrained. But you do have significant automatic or discretionary fiscal stabilizers at the federal level. It is at the federal level that you run surpluses in good times and deficits in bad times. Is that the logical consequence of what you also need to make that system work? And does that make the politics just even more impossible, i.e., we might have Eurobonds if we agreed that they were always funded with a federal budget which was always in balance, but can we have Eurobonds which also have to be sometime in surplus and sometimes in deficit, and therefore playing the role as automatic fiscal stabilizer?
Thank you. I would collect a couple more questions before giving you the floor. There was, yes, there, sir.
I have a question related to what seems to be a structural reluctance of central banks to consider a broader definition of inflation. So if asset prices were included in the inflation definition, that would make monetary policy much more countercyclical effective, and there would be less of a risk of the debt overhang, and also we would be less concerned about deflation, because in the definition of inflation we would have actually also the asset prices. Thank you.
Are there more questions? I have one myself. So I'm following up with some of the previous comment. You said, Thomas, that, and Axel was on a similar line, that in future maybe we should make debt defaultable and make that more explicitly defaultable, because debt has been default in the end in the case of Greece. So now the question is, suppose that you want to assess the credibility of that mechanism. You want to ask yourself what happens in the case, if you want, out of equilibrium, as we say among economists, in which still the default stage is reached. Well, we have examples like Iceland, but in Iceland there was something else that helped a lot, big devaluation. So now if you stay inside the union, it's going to be much more painful to make the adjustment, because what you need, people like it or not, is the devaluation of wages. And for Greece, I think it would be tempting at this point if you take the whole thing. That now today we will have George Alagoskoufis telling us more about them, probably disagreeing with this. But it would be tempting to say, well, let's take the whole thing and make the adjustment as many other countries have done in the past, including both default on debt and or monetization or whatever, and devaluation. That's what essentially the setup, the current setup of the eurozone does not allow. I don't think it's convincing the comparison with the states within the U.S. because they run a much smaller share of the their debt means much less in terms of the GDP than it is the case for Greece relative to its own GDP.
Shall I start?
Okay, let's have a round. So Thomas, maybe Richard.
So, Lord Turner's question actually also linked, I guess, to Guido's point. So I'm going to say something I think to me is very clear, which is pre-banking union and pre a bunch of other stuff we've done, there was a dilemma, which is default versus exit. So in a good currency union, you must be able to have default without exit. Pre-banking union and pre of some of the other mechanisms we had, the fear, and I think then we can debate whether that was fear was founded or not, but I think it was partly reasonable. The fear was if you're going to have default, you're going to have exit. There is no reason in the world where these two should be linked. You can perfectly well default on your debt without leaving the currency union. Some of the value added of having the same currency in terms of prices, in terms of many of the benefits, has nothing to do with debt. So you should be able to default without exiting. I think that's kind of the requirement. The question is, how do we get there? So to me, the first step to get there is the banking union. That's the first thing. If you don't have the banking union, forget it. Because the first thing that happens if there is default on the sovereign debt is the banking crisis. So if you're left dealing with your own banking crisis without your own currency, that's deadly. Okay? Therefore, the logical proposition was once you have a working banking union, then in theory, you're a step closer to being able to defaulting without exiting. So I think that's kind of the first thing. Now the question becomes, exactly what do we default on? How do we deal with fiscal multipliers and things like that? So I don't think the banking union solves everything. At the same time, if you look at the numbers, so first of all, for the US, just something to keep in mind. Imagine there's a shortfall of $1 in a particular state in the US relative to the average. And ask yourself, how do they smooth that shock? Right? So roughly speaking, if there is an asymmetric shock of $1 in the US, they're going to smooth about 80 cents on the dollar. Okay? And the federal budget is only going to smooth about 20 cents on the dollar. Okay? Then 30 cents on the dollar is going to be smoothed by capital markets, and 30 cents is going to be smoothed by borrowing and lending. All right? So these 30 cents of borrowing and lending, if we have a banking union and the funding costs are equalized, we have it. So that's 30 cents of smoothing. The capital market union, that is equity integration, which we have done very little progress, I think is critical. That would add another 30 of smoothing that without a federal budget. Then you have the federal budget. But if you look at the federal budget, the kind of items we are thinking about, say, unemployment insurance, this is not very big, and that's highly predictable. This is not something that creates a lot of tail risk. We know, I mean, it's countercyclical, but that's a few points of GDP. It doesn't have to be gigantic. The thing that is very hard to smooth or to have automatic stabilizers for are the very big risks. And I think most of these risks are financial. So once you remove in other words, like think about, the Bank of America is a huge bank in the US. It's incorporated in a tiny state. So there's no way North Carolina could just bail out Bank of America. But it never needs to. Okay? And then how much of a difference would it make for North Carolina to have a little bit more unemployment insurance benefit or not? That's not huge. That they can probably deal by themselves. So I think at that point, my view would be that we need to find a system where debt can be defaulted on without exiting. The bank union is the big step towards that. And then the critical question is the transition path. That is, if we had to write the rules today, to me, it would be clear that we would say something like the blue debt, red debt proposal from Bruegel, which is you just say up to, pick your number, 20, 30% of GDP, we have some kind of common safe asset. Anything beyond that is explicitly defaultable. And the market is going to price it right away with very high spread if you start to misbehave. That's I think, is a better way to have fiscal discipline than tight treaties, but that's not where we are now.
Yeah, I'll start. Well, I'll just disagree a little bit for the sake of disagreeing. Why not? I don't. I do agree, of course, with Thomas that you have to be able to have default without exit. I think exit would be disastrous. Exit would be disastrous for a country that going out, if only because of the balance sheet effects for households, for firms, throughout the economy. But I also don't think that devaluation of a new currency would be an answer because it would just get you back into the same devaluation, inflation, rhythm that a number of these economies had before the progress towards monetary union. So I don't think that that's the answer. Indeed, you want to be able to default without exit. Now, actually, we've had it already without a banking union. So I'm not quite sure why Thomas says that a banking union is essential. Of course, banking union would improve the situation. And of course, if the single supervisor does enforce a rebalancing of bank portfolios of sovereign debt to reduce the home bias, that will make it better. But we've had a default already. Greece defaulted. The world did not come apart.
The banks were backstopped.
Sure, but you can backstop them. That didn't require banking union to backstop the banks. So that's just not. I mean, it's just not there. The question that I would put to Axel is a very fundamental one about the ECB and its responsibilities. I hear what you said. You were very clear on it, that the ECB can't deliver inflation now or even in the foreseeable future. The thing is that that's their job. And, they've defined it themselves. It's a very simple job. It's in the treaty, price stability, and the ECB defined price stability as close to, but not above 2%. That's their job. It's a very simple mandate. Right? If in the private sector you were to fail to deliver on a mandate like that, you'd be sacked. Right? And I think this is a problem. You can say, I mean, I see perfectly well the obstacles, and you're quite right that they're there. But for those who are combating the Draghi view of the world and Draghi policies, etc., I'm asking, what's their alternative? And if they haven't got an alternative, right, then maybe they should find something else to do.
So can I solicit some more interventions from the public? Okay.
Well, so first of all, not having been a central banker, Richard, you of course overread 3 or 4 things that are important. First, it says over the medium term, not every instant. And so how long is the medium term? It can be pretty long. Second, close to 2%, depends how you define closeness. For me, 1% is close enough to 2%, actually. If it's over the medium term, I can have a period, and look at the ECB before the crisis, there was 3% inflation for some time. So if you actually measure that very, very tightly, you go back to price level targeting rather than inflation targeting. So I think this whole hoo-ha about deflationary forces, in my view, is completely overdone. I think there is a strong deflationary force in the economy, and aiming at 2% as if an optimal degree of losing the purchasing power of money with 20 years, half of your money is gone with 2%. If that is the kind of norm you want to gear yourself to, independent of the state of the business cycle, I think that taking away that discretion and forcing 2% every moment in time would actually be the worst designed monetary policy I've ever heard about. And central banks aren't as dumb to do that. So they have clearly discretion, there are choices, and they can have a number of compromises that they have to do, and there are trade-offs. One additional point on what we talked about. So no, I would not think it helps to put asset prices in there. It helps to focus on consumer prices. We're there to protect, central banks are there to protect the purchasing power of citizens, and that is largely defined by the consumer prices and not by a broader set of prices. And last not least, on the discussion on Euro bonds, what they're asked on, what is defaultable and what not. Look, go back to my above the line, below the line comparison. As soon as you want to guarantee jointly and severally any form of European issue at the European level, forget about the below the line. You have to go above the line. So I think what the Europeans need to do is clearly to make the cost of Europe and to make the cost of national policy choices visible. Give me an example. The 4 big ticket items on any government budget is healthcare, Medicare, pensions, unemployment insurance, and security and defense. The first 3 are very clear national choices. Only on defense and security, if you harmonize that, you can have a 10% budget that is jointly. We have joint troops between France and Germany in Alsace-Lorraine. Clearly that is joint expenditure, jointly decided under NATO remit. That can be funded jointly. I have no problem. But the other thing is, when people talk about joint funding, they jump to debt, deficits, and bills. They don't talk about taxes. So let's have a European tax for European defense. Let's assign for everything else a minimum coverage if you want to talk about joint expenditure. But then that means you basically have a European standard where the normal work week is 45 hours. If the French want to have 35 hours, let them have a national tax to make visible to French citizens what the 10 extra hours of working less relative to European average cost French citizens. How long do you think the 35-hour week would stay in place if the cost of 35 hours was visible to every French citizen every time he switches on the TV? I would say no longer than a year. And so you do need to talk above the line if you want to talk about joint funding. Below the line is the minimum intrusion, and there, in my view, the best number is 0. That's where I'm coming from when I talk about European fiscal policy and other policies.
Just one thing, very quickly on the...
Let's see if there are questions now, sorry. Then we have a round again. Yes, Albert.
Yes, it seems to me in all this discussion, not only here, but in general, and all the discussion about Europe, fiscal policy, the banking union, saving the banks, saving Greece, Greece default, and all of that, there's a huge elephant in the room that nobody ever talks about, which I think is the following. I mean, Europeans are obsessed about redistribution and equality, and they feel very superior to the US. That would be sort of they are bad people, they don't care. So within a country, within each country, everybody is concerned about redistributing from the rich to the poor and all of that. Across country, there is absolutely no sense in which rich people from country X would be willing to redistribute in one way or another to an individual country Y, being that through a banking union, a default agreement, tax transfer, and so on. So as Thomas was saying, obviously within the US there are huge redistribution across states. So my question is, how feasible it is a currency union if politically the view is that absolutely not €1 has to go from country X to country Y in every shape or form, and when it does in a way which is often under the table, confused, and not in the most efficient way.
So, actually, I have a question which is somehow, unless there are more from the public, I have a question which is somehow related, maybe not too directly. So, how would you think we should handle, maybe Axel first, but everybody, with the transition strategy, the exit strategy? So there are a set of political constraints now that are becoming more and more binding and urgent, especially in Southern Europe. Let's take Italy, for instance. Italy has currently a government that at least promises, you can believe it or not, that there are structural reform underway. Now, we know that those type of reforms, especially those in the labor market, are not going to pay off in the next few months. They are going to pay off with some delay. At the same time, 35 to 40% of the parties are taking a very strong stand against and with the euro, if not with the union. And I think the same is happening also in other countries. So how is this political constraint going to affect? I mean, let's leave alone for a moment the construction about the future, but let's think about what the best strategy to deal with this. It's one possibility is, of course, let those forces take over, break up the union and everything. But if instead we want to stay inside, so what is the type of contract that can be credibly written? I think that exaggerating the fiscal austerity is going to choke off the attempt to make reforms.
You want to go first?
Okay, let's have a round.
Yeah.
Thomas, you were.
Yeah, just so one thing that when we talk about exit versus default, there is also the issue of devaluation. But if you look at the data, the one thing that closed very quickly was the current account deficit. They are gone. So all of these countries, we still have fiscal problems in many of these countries, but Spain does not have a current account deficit. Yep. So the devaluation has been done. In fact, it's been remarkably fast if you think about it. So I think we do have a public debt problem, but in terms of devaluation, that's way overblown. It's like it's not, and there was no devaluation between Florida and Arizona, and they had a very large increase in unemployment. It took the wages were just as sticky in the US. That's not a critical difference. So I don't think we should just overweight the idea that it's a miracle to exit and then devalue your exchange rate. That's kind of bogus. Now, so I think the real issue, exactly the one we struggle with, is the level of debt and the kind of redistribution we want to have. So to Alberto's question. Okay, so we have structural funds, and they are explicitly redistribution from rich to poor, and they are at the level of the EU, actually not the Eurozone, and people vote for that. So I think it's extremely badly designed, so we can talk about that, but the idea that there is absolutely no desire for this kind of redistribution, I think it's not true. In the US, it's probably higher. At the end of the day, it's still not huge. I mean, I think of currency union as being mostly a financial construct. If you think about the financial requirements, they have some risk-sharing properties. Lender of last resort, like Richard was saying. These are feasible. These are feasible without very large redistribution. That's what I think.
Thank you. Richard. To Alberto, I think, first of all, I would agree with what Thomas just said, but also we have had redistribution in Europe for a long time. The structural funds were substantial redistribution. For a time, about 4% of Greek and Spanish GDP was coming as an annual flow to those countries from the rest of Europe. That's pretty substantial redistribution. And the body politic was willing to accept it. Maybe that has changed. I mean, a lot of things have changed in the body politic, most of them not for the good, but it's not as if there's no precedent. The other question about devaluation, I'm quite with Thomas there. I think there I would probably not go along with Fabrizio, that you need a substantial cut in wages. I don't believe it. This is another argument, and it's a quite different argument about what the right real exchange rate is to use and so forth. But the competitiveness story that is all due to divergence of unit labor costs, I just think is wrong analytically, and it's wrong empirically. And indeed, we have seen a recovery in the current accounts and trade balances of these countries, very substantial, and not just due to import compression because of recession. There's been very substantial expansion of exports, right, despite difficulties in the global economy. So there's something, that Spain and Portugal, and so there are things that they're learning that they can export, right, when they're under pressure, and they're doing it. So that I don't think it's wage competitiveness that matters. And there's some new literature that actually backs this up on a micro level about what makes companies successful and so forth. It's another matter.
On your question, I agree with both previous speakers that we've seen a lot of wage and relative devaluation, internal devaluation in Greece. The problem that you have is if you do a wage reduction and at the same time you do not just free up completely product markets, you actually are impoverishing labor and you give a monopoly rent to capital and all other factors of production. So unless you actually come down with labor cost in sync with opening markets and allowing these structures to break up, you will not restart employment because the other factors become the limiting factor. So I think that is one of the things that needs to happen in countries like Greece. Domestic devaluation is not enough. It doesn't come with the necessary kickstart that the economy needs. On Alberto's question, I would put a caveat for Europe. You're right, there is some degree of the US, and it's largely to the fact that at the national level, you have what I talked about, the four big items. You have unemployment insurance, you have the pension system, you have Medicare and healthcare, less developed than in Europe in these systems, and you have a common defense budget that nobody contributes. The cost of defending the South Italian perimeter of the EU against immigration is a different cost for the Italian government than it is for a landlocked country. So I think there are areas of European common expenditure that could be reviewed and they could be funded at the European level. There is a rule in financial policy that says everything should be at the appropriate level and funded there. So clearly there are some European courses. Where I do think the whole journey in Europe goes in the wrong direction is everyone seems to think more Europe is good. You know, like motherhood and apple pie. That's not the right thing. Actually, everything should be done at the level where it needs to be done. And there's a lot that Europe now has a vision to do at the European level that, in my view, could be better done at the national or even subnational level. Redistribution in Germany has become very much under pressure. Even the Länderfinanzausgleich in Germany is pressured by the states that pay into the system because it basically provides too easy access to funding and lack of reforms in the countries in the Länder that draw on it. So even within a country, that has become questioned. And in Europe, what you need to do is you need to have a European unemployment insurance scheme. But believe me, if you vote on a consensus vote on how elaborate that would be, you have a hard time looking for a number that's way above zero. It might be a minimum insurance system that shows basically the commitment of Europeans to have an unemployment union or an employment union. You vote about the next issue, which is healthcare and Medicare. At the European level, again, the vote would be different. What's the problem? The problem is these are all insurance mechanisms, and the worst moment you can set up as an insurance mechanism is after the accident has happened. Because the payouts are known to all the players. And that's where Europe is at problem. We started wrong by not putting these things in place in the good time. And now we're in the bad times and the payouts are known. And that's why the ones that be net contributors in the system are very reluctant to do it because they don't believe they've given sufficient insurance that the next accident will not happen. So Europe is in a very difficult political situation. I think the economic analysis, at least to me, it's blatantly clear. Now, I might not sound very European, but believe me, I am. Because if we construct Europe the wrong way and forget about incentives, forget about starting conditions, and setting this up in the right way that even for the creditors and for those that are contributing, this is set up in the right way, this will be like a bad marriage going into the third 7 years. There is a centrifugal force that we need to address, and it's about institutional design that needs to reflect where we stand and where we're likely to go over the next years. If we get this wrong by simply saying, like motherhood and apple pie, we just need to exercise solidarity in Europe, believe me, that will not come around because people will not go that road. So we really need an institutional setup that starts with minimum aspirations and builds up over time, given if the track record is right. If we create a European system that is overloaded at the European state, people will walk away from it. That's the biggest risk that European politics is at the moment, to overload the system and to go to the wrong incentives. And believe me, I see that pretty clear, because if you live in this country, you see how incentives in a system where you have national, regional, and local can be organized in a different way with competition among the local, and it can work too. There is just not one way this works. And actually, with the right set of incentives, it works. With the wrong set, it doesn't work. Right set incentives, I don't think this is what Europe is trying to put in place.
So, thank you. I think we are about to close. Very, very quick. Okay. So, thank you very much, everybody. And so I think we have had a very interesting discussion, and I hope I see you back this afternoon.